Probably does. Okay. Step number 2, diversify, diversify, diversify. What's diversification about? Not putting all your eggs in one basket, isn't it? Yeah, spreading your risk around the market. Absolutely. Now, this is where I'm going to just talk about CFDs just for 1 second. And if you've never heard of a CFD, it stands for Contracts for Difference. Okay? Very popular at the moment for this major reason here. CFDs help us manage our risk. They actually help us manage our risk and also profit from a falling market, which I'll talk about next. CFD is very simple to explain. A CFD is designed to replicate a securities transaction. Give me an example of a security. We've talked about one already today. BHP? It's a security, isn't it? So a CFD on BHP is just designed to do everything BHP does, okay? So if I'm over here, if I'm BHP, CFD's over there. If I'm BHP and BHP goes up, let's say this is BHP on the ASX, and that's BHP as a CFD. Let's say I'm over here, I'm BHP, and I go up 10 cents. What does the CFD need to do? Go up 10 cents. If I go down $1, that CFD is going to go down $1, isn't it? If I pay a 34-cent dividend, the CFD is going to pay a 34-cent dividend. If I split my shares or consolidate my shares, the CFD is going to do exactly the same thing. The CFD is designed to replicate a securities transaction. Okay? Well, then the question becomes, well, if the CFD is exactly the same as a share, why would you trade a CFD? Does it cost you less? That's the next slide. Okay, so question is, in that last example, BHP was about $40. If we were to buy 100 shares, it would cost us $4,000. Using a CFD, we only need to use $200 of our capital to do the same transaction. You see, because a CFD is not a share. It's just designed to replicate a share trade. So there's no need to put up all of the money. All we're interested in is the difference between where we get in and where we get out, plus any dividends we can get in the meantime. Okay? Let's have a look at this a little bit more closer. Now, the deposit, the $200 represents a deposit that you need to put down to secure that BHP transaction, okay, for your contract for difference. What other transaction might we do in our other investing lives where we put down a deposit to buy something? A house, isn't it? Yeah, that's what everybody does. So what we'll do is, let's say we're looking at a property worth about $500,000, okay? Now, do we go to the vendor and say, here's $500,000? No. We go to the bank first, don't we? And we put down typically about a 10% deposit. 10% of $500,000 is $50,000. Okay, so we put down a $50,000 deposit and we borrow the balance, $450,000. Now, what would happen if the price of that house increased to $550,000? Now, there's no stamp duty here, okay? There's no real estate fees. This is a perfect world. But if the price went up by 10%, which is $50,000, and you sold out, what would your profit on the transaction be? It'd be 100%, wouldn't it? You'd make $50,000. For the people that aren't quite following this, let's start again. You bought a house for $500,000. It went up to $550,000. You made a $50,000 profit, but you only used a $50,000 deposit to do it. You've doubled your money, haven't you? Yep. That's what happens in property. I tell you what, that's exactly what happens in shares. CFDs are basically property investing for shares. It just enables you, rather than having to put up all the money for BHP, you put down a deposit on BHP. You're effectively borrowing the rest, but you now don't need it to go up so much to get a higher return, do you? And this is what people are doing all the time. Some people have 2 or 3 or 4 investment properties using this method. And they probably didn't even realise that this is what they were actually doing. Because if you had $500,000, would you buy one house? What would you do? You'd buy a few houses, wouldn't you, using this method? Same thing on shares. What we're going to try and do is, instead of having a small amount of money and putting them all on one share, we're going to take that money and we're going to get a few shares with that money by using this methodology of just putting down a deposit and borrowing the rest. Okay? Same thing for BHP. If we were going to buy $4,000 worth of BHP, the deposit on a CFD is only 5%. So you put up $200 and you control $4,000 worth of that asset. Now, if BHP goes up to $4,200 in value, you've just doubled your $200, haven't you? What's the flip side? What if BHP goes down $200 in value? What's happened to your $200 investment? It's gone, isn't it? Same as property. If you put $50,000 in a property and that $500,000 property went to $450,000, you've now got no equity in that property, isn't it? People are doing this all the time. Okay? And certainly people are doing this all the time when it comes to shares. Okay? That's why CFDs are becoming so popular right now. The ability to control more shares with a small amount of money. And this is going to become important if you do have a limited amount of capital. How many people in the room would say they fall into the category of having a limited amount of capital? Show of hands. Because I'm going home with the person with unlimited capital. Everybody's got a limited amount of capital. So this is important. It's important to everyone. Okay. So let's say we had $5,000 to get started with our investing. And if we were going to do that with normal shares and we bought $4,000 worth of BHP, we've only got a very small amount of money to keep diversifying, isn't it? Now, let's say the next trade we saw that came along was Rio Tinto. How many Rio Tinto shares can we get with $1,000 right now? Anybody know? It's about 13. Yeah, 13. So we've got 100 BHP, 13 Rio. That's it. We've used up all our money. Is that diversified? No, not at all. You've got all your money in the resources sector in 2 stocks. Very hard to do if you're using this method. If you're using CFDs, however, what you can do, don't put up $4,000 on BHP, just put down $200 on BHP. Then put down $200 on Rio. I think that's got the resources covered. Where do we go after that? You tell me. You're investing right now. Banks, super. I mean, that's a bit lazy though. Which bank? Commonwealth Bank, super. Great. So $200 on CBA. Any more banks or keep going? $200 on Westpac. We've got four stocks now. 2 resources, 2 banks. I think that's enough banks. Where to now? Health, give me an example. ResMed, $200 down. Great, 5 stocks now. How about some utilities like AGL Energy? $200 down. Wesfarmers, $200. We could keep going. In fact, we could get 10 investments at $200 and only use up $2,000 of our capital, isn't it? But we've got diversification. We've spread our risk across the market. Do it the other way, it's very, very hard to do. So this is how you can use CFDs to actually reduce your risk in the market. What about another stock? Should we put some Telstra in that portfolio? I didn't think so.